Here's the weird part. Rich people usually do not avoid taxes by hiding bags of cash. The bigger trick is that the tax code treats different kinds of money very differently. If you earn a paycheck, taxes usually show up right away. Money comes in, taxes come out. But if your wealth is mostly stocks, companies, real estate, or art, the story changes. You can become richer on paper, without income showing up the same way. That is the first big idea. Wealth is not taxed the same way income is. If a billionaire's company's stock rises by $10 billion, they may owe zero tax that year just from the stock going up. Why? Because in the US, you usually owe capital gains tax when you sell the asset, not when it merely becomes more valuable. So the simplest strategy is, do not sell. This is called unrealized gain. It is real wealth, but it is not usually taxable income yet. Now comes the famous three-word version. Buy, borrow, die. First, buy assets. Or start a company. Or get paid in ownership instead of ordinary wages. Second, when you need spending money, borrow against those assets. Loans are not taxed like income because you are supposed to pay them back. So instead of selling stock and triggering tax, a wealthy person may borrow cash using the stock as security. They still pay interest. This is not free money. But for very rich people, the math can work surprisingly well. If the asset keeps rising faster than the loan costs, they can live on borrowed money while their wealth keeps growing. Sometimes interest can be deductible, depending on what the borrowing is for. The rules are complicated and limited, but the basic idea matters. Third, die. Morbid but important. When someone dies, heirs may receive a new tax basis on inherited assets. People call this the step up in basis. Basis is basically the tax system's memory of what you paid. If an asset was bought cheap and is worth much more at death, the tax memory may reset near the higher value. That can make decades of gain disappear for income tax purposes. That is why buy, borrow, die is powerful. Never sell, borrow instead, then pass the asset on. Another tool is the capital gains rate itself. Money from work can be taxed as ordinary income. Profit from selling an investment held long enough may get lower long-term capital gains rates. So if you can turn compensation into investment gain, the tax bill may shrink. That is part of why carried interest is controversial. Some investment managers can have a share of fund profits taxed more like investment gain than salary, if rules are met. To critics, that can look like labor income wearing an investment costume. Real estate adds another layer. Owners can often deduct expenses. Repairs, mortgage interest, management costs, and depreciation. Depreciation is strange because a building can rise in market value, while the tax code lets you deduct part of its cost over time. That can make a profitable property look less profitable on paper. Then, if the owner sells, a 1031 like-kind exchange may let them defer tax by rolling the money into another qualifying investment property. Deferred does not mean erased. It means the tax bill gets pushed into the future. But if you keep exchanging until death, the deferral can combine with the step-up in basis. The pattern again is delay, delay, delay. Charity can also reduce taxes, especially when donating appreciated assets. If someone donates stock that went way up, they may avoid selling it themselves and may also get a charitable deduction within limits. Sometimes this is genuinely philanthropic. Sometimes it also gives the donor influence, reputation, and tax benefits at the same time. Then there are trusts, family partnerships, and estate planning. These tools can move wealth across generations, use exemptions, discount certain values, and control when taxable events happen. The federal estate tax only hits estates above a very high threshold. For 2026, the IRS lists the filing threshold at $15 million. So even before planning, many fortunes are below the federal estate tax line. With planning, larger fortunes can reduce what gets taxed. Businesses have their own version of the game. A company pays tax on profit, not revenue. So every legitimate deduction lowers the amount left to tax. The line between normal business expense and aggressive tax strategy can get blurry fast. And this is where lawyers and accountants matter. Rich people can pay experts to design the timing, structure, and paperwork. Poor and middle-class people mostly have income that arrives already labeled. Wages, tips, salary. Rich people often have choices. That is the whole secret hiding in plain sight. Not one magic loophole, but control over timing and category. Illegal tax evasion is hiding income. Legal tax avoidance is arranging life so less taxable income appears in the first place. So when people ask how the rich avoid taxes, the honest answer is, they own things, borrow against things, donate things, exchange things, inherit things, and hire experts to make every step fit the rules.